Hello, folks. Welcome to Market Trends. I am David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone today. We share a few disclosures with you guys in the chat. And, we had kind of talked about on Monday the market's potential to probe down toward 5,700, and it has kind of maintained that, sort of overall behavior. Um, we look today, what's kind of interesting today, my focus is that the weak dollar saves the day, as I said it. And I think it's kind of interesting, and it's a little bit maybe a little bit of a false signal, but I did want to emphasize it because in my view, yesterday's bounce really resulted from things happening in the currency market. So let me just quickly show you some standardized returns here very quickly. Standardized returns, some of the ETFs we're going to talk about. So basically, it's interesting. We did talk earlier on Monday. We do state of the market. And state of the market, we look at the indexes. We look at what the sectors are telling us. And one of the things that we'd been talking about for a few weeks now was the relative performance of consumer staples, their relative strength. So that's our standardized returns. Let's look now at our key ETFs. We can see here, like in the last month, for example, the consumer staples, XLP, real estate, and healthcare. These are like safe havens, and they've been all the leadership on a year-to-date basis. Healthcare, yep, it's still the leading sector. And look at where our weakness is. It's discretionaries and tech, right? And those, that's really telling us that there is very much a sort of, there was a risk off going into this, pullback. Um, and it gave us a signal of that, and we had been talking about that. So I'm going to now quickly look here at the MTES workspace. Now, actually, let me remind you guys, if you go to tradestation.com, go up here to Insights. That is our blog, Market Insights. And then if you go down here, there is this blog post, Weak Dollar Saves the Day. That's the rundown and the talking points we're going to be having for our webinar today. So if you want to follow along, tradestation.com, Insights, and then the top blog post on the blog. But basically, this is the S&P 500. You can see the hourly charts. Now, in the blog post, we have up here, we have in this blog post, we have basically, the downloads are here. And we're going to get to a list of foreign stocks I want to share with you that's also listed here. But if you go to this download and you load the easy language files, which will give you the special studies, and then you open different workspaces, one of those workspaces is MTES. And that's what we have right here open for you. You can see basically showing the S&P cash index on an hourly, S&P futures index over here, both on hourly. This has some special indicators. But I think what I want to point out very quickly was that, we had this weak dollar the last few days, and I think it's actually been giving the market, it's been supporting the market more than people really realize. People said yes about tariffs and this stuff, but in my view, that's not what the trigger was. The trigger was, I can't remember if we've talked about this, but basically the Germans are going to lever up their economy and just spend like $500 billion on defense. And Germany historically has not done that, or I should say that they plan to do it. That is what the talk right now is. Officially, it has not officially happened, but that is the expectation now in the German political situation, is that they're going to lever up their economy and they're going to spend a bunch of money. And what that did was it triggered a massive rally in European stocks, European assets overall, and that in turn, also lifted the euro, and that pushed down the dollar. So when the dollar falls, it's usually going to support risk appetite. And I think that's really the key thing I want to mention here, is that the main thing was that the weak dollar yesterday kind of made it harder for the market to go down. And I think that's one of the main things that was really happening. But we look right now, and I think it's important to realize, we get back to the overall market here, is that we basically have no signal yet. This is the hourly chart. This thing has not given us any kind of signals. MACD is falling. The 50-hour moving average is falling. It briefly went to oversold, but it didn't happen at a time when two of the three signals were in the same direction. If anything, the signals have remained bearish. Like this rally today happened at a time with the 50-hour falling and MACD falling. So that was a confirmation of a move down. So I think right here, when we look at this, there's nothing here giving us much of any kind of signal that it's time to be looking for much upside. Now, the thing is that if you look, we basically have retraced. I'm not going to draw it on this chart, but we basically, where we started the week, we've retraced that. These highs, these days here, was basically a 50% retracement of this. And yesterday, today as we bounced, we basically bounced halfway up yesterday's candle and then failed. Yesterday was an inside day, which is a bearish, which is a reversal pattern, regardless. I'm not reversal. I'm sorry, it's a continuation pattern. It's not reversal. So basically, what we had was on the daily chart, we basically had the S&P 500 moving lower. We had an inside day, which is a continuation pattern, and then we had to follow through today to the downside. We retraced, like I said, half of the drop, and then we retraced half of the candle and failed. Now, to me, the bigger picture is really when we look at what is happening overall. And I would say that there's an article we wrote back on the 9th. I'll share the link here. It's called "Is the Opposite of Goldilocks Taking Shape?" And I think that's the way to think about this market, which is essentially that it's not bad enough for the Fed. The economy is not bad enough for the Fed to cut, and it's also not good enough to justify upside. At least that's how the market is viewing it right now. So think about this: we still trade for about 21 times forward earnings on the S&P 500, depending how you look at the estimate. And that is something that requires really perfect conditions to be in place. And as we look out into the future, what are we seeing? We're seeing earnings estimates get cut. We're seeing economic estimates go more negative. We are seeing all kinds of negativity and concern. And if the S&P was trading at 15 times earnings, people would view that as, oh, all the bad news is priced in. But when you really look at it now, if you're trading at 21 times earnings, is it possible to say all the bad news is priced in, or is it possible to say that the bad news is happening and it's not priced in, that the S&P needs to trade at a lower multiple given this negative sort of news flow that we're seeing in this overall view? So I think that's really the key thing right now. And another thing I think it's important about this European story is that if we look over here, I'm going to just go very quickly to a trading view chart just to quickly illustrate. In fact, let me do this one, DRRC. Well, this is interesting because it did show the incredible sort of move in the European stocks, which the key thing I want to talk about, though, is that treasury yields. I'm sorry. This is the euro on the weekly. All right. Let's just look at at treasury yields. This is the most important thing. On State of the Market on Monday, we said the 10-year had that space down to 4.1. But where did it go? It went down to 4.1, and now it's bouncing. So the German situation can result in higher yields. Japanese yields are moving higher. The 10-year bottomed at 4%. Today, jobless claims were not terrible. There are reasons people are somewhat nervous about the economy, but at the same time, is it bad enough yet for the Fed to really get dovish? I mean, that's, I think, really the tricky question. So I think right here, we kind of have a toxic scenario, which is kind of the worst of both worlds. On one hand, we have higher yields. We have earnings estimates coming down, but the economy is not bad enough to trigger rate cuts. So I think, you think about it, right now, where inflation is, that alone kind of argues against rate cuts. And then the other thing is that as we move forward, companies are going to cut guidance because what does management do? They're generally conservative. If you give management an excuse to basically lower guidance, they will. And Trump gave them this massive excuse called tariffs. So, we're going to basically cut guidance. So now it creates this environment where everyone wants to be kind of stepping back and being cautious. And when that happens, it sets up something of a sort of situation where somebody has to kind of, stop first. Either companies have to stop getting negative, or the tariffs need to go away. And until one of those things happen, then essentially it creates just a lack of buying in the market. And I think that's really the scenario we see here. Now, again, if we were trading at 15 times earnings, that would be different. But when we're trading at this really high level, and there was this expectation of near perfect conditions this year that are now maybe not so perfect, it just creates a lot of space. And I think that's what we have to realize is happening here, is that at this point, it's hard to justify from a fundamental perspective where the market is. And then when you look at it technically, it's giving all sorts of kind of warning signs. And even with it being over, in many ways oversold, a lot of the overall things are not yet telling us that it really is, in any kind of spot where people would want to be stepping in. So I think it's also important to realize when you look, the beige book came out from the Fed yesterday. They were also talking about inflation and tariff fears in there. And I think also the thing is that if the Fed is going to start getting more dovish, to bring rates down and to see yields come down, we need to see the economy get probably much worse. For example, jobless claims still under 250,000. I mean, for the Fed to step in and start getting prematurely dovish might require something much more like 300,000 or more on the jobless claims. And if that happened, then we're going to freak out over bad economy and bad earnings. So right now we're kind of in a lose-lose scenario where things get the economy gets worse and that's bad news, or the economy stays strong and that's bad news because then the Fed doesn't cut. And on top of that, given the fact that we have the European situation and the Germans about to borrow a lot of money or expected to do this new debt issuance overall, that also creates a very difficult environment for the Fed to go against that. If we saw an environment of the Germans, borrowing a lot, spending a lot, their yields moving higher, and the Fed tried to cut, that would actually be much more inflationary in the United States. So it's really right now a kind of rock and a hard place, I think, when you look at these sort of factors in place. Now, tomorrow, when we also take a step back, we have to realize we have payrolls in the morning, and Jerome Powell is going to speak at like 12:30 Eastern. So those are like two more kind of catalysts that are out there right now. So I just look at these things, and I want to kind of point that out. The market has pulled back a fair bit, but at the same time, there's no real reason to kind of take that more optimistic view. I mean, people might not see a lot of reason. Now, sentiment is extremely bearish when you look at the surveys, but when you look at multiples, they're not that low yet. So it's easy to say sentiment is bearish based on a survey, but has the market gotten cheap based on these sort of levels? And in that respect, by most measures, it's still at the high end of its overall valuation. So to me, that's the basic thing we're seeing here. So let's look at the S&P, this indicator here. Now, I already explained how this thing works. People, the idea is to look at two of the three indicators, and MACD is basically, you know what MACD is, the oscillator with basically pointing in momentum. The 50-hour moving average speed is this red line here. It's an average and tells you when it's rising and falling, and then stochastics. So stochastics are contrary. So if it's oversold, it's potentially bullish. But many ways, the sort of things people want to see for this is to have it kind of have drops to oversold, but not just sitting at oversold. That doesn't really give us anything. But if you look here, where it like rallied up to overbought kind of in the overnight, and then you see what happens as the overnight ends. So I think it's interesting also to remember here that this is one of the reasons why futures can make a lot of sense in a volatile market. Now, I'm not sure exactly what time the European markets open, but it was probably somewhere around here. So very often, if you look, you're going to start to notice when you look at futures that these sort of things start happening. And depending on how much you want to do things overnight or anything else, it just realize that with futures, it gives you that sort of opportunity. The other thing is sometimes you can enter a position during the day and close it later. And sometimes that's something that can potentially make sense. So, in an environment like this with a lot of volatility and a lot of correlation, things like futures can make a lot more sense than anything with any kind of individual stocks. And that's one of the things we talk about. We have our volatility cycle that talks about periods of intense correlation and high volatility. And basically that's what we have right now. So the idea of trying to do things with individual stocks is probably something a lot of people are not going to be looking at. So I want to just kind of point that out. Now, if we look overall today as well, I'm going to go back to my MT main here. Look at our chart. And basically, again, we sort of have continued bad news in tech. Mongo database had, weak guidance. When you look at the high multiple growth stocks, none of them, the news is not breaking favorably really for any of them. Things like Marvell also had bad news, CrowdStrike. So basically, a lot of these are AI names that have just completely undone the rallies that we've seen in recent months. So I think it's important to realize that the AI trade, I don't want to say it's dead necessarily, but I think it's possible to say it's dead. And when I say dead, maybe it's dead for 6 months or a couple of quarters or something like that. And so I think right now that's really the thing that's important. And so what I'm actually looking at right now, and that I've talked about, is that basically the global stocks are outperforming. So now I want to go over here and go to this other workspace. This is actually the chart I have here in my rundown. If you look at some of the points in here, I talk about how RSI was holding above oversold, and I've used RSI as a sort of indicator for trend. And from my perspective here, though, um, we have to watch out because if RSI, well, if it goes oversold, it's something that has often kind of been a signal that there is that potential for more move to the downside. The RSI has not been oversold in a long time, and I'm kind of watching for that. But you can, this is the chart as of yesterday, and we tried to hold these levels, and basically it didn't work. So I mean, at the time I was preparing this article yesterday, I was looking at the potential for it to maybe hold because I had to basically work off the levels from yesterday. But this is a very sort of a market like this when things are so volatile, it's really difficult to make a statement the night before. There could have been something when the Fed, when the White House had changed its mind on tariffs or something. But right here, these are the basic things I was looking at. But this is why I wanted to point out the futures workspace, because the futures workspace here does. I'm sorry, this one here, the MTES, it does kind of give a better sort of map of how to work with the market. So as we look here at the rundown, I think it's really important to see that the European market is really outperforming the S&P 500 this year, and the dollar index is actually, look at the dollar index here in Trading View on a weekly chart. This is like a really big drop. Let's actually look here on this. This shows my rate of change on a percentage basis, and if you look at this here, the weekly drop of the DXY on trading, according to this, is the biggest weekly drop since November of 2022. So that was also at the beginning kind of the market, and well, that was essentially right after the um the um the S&P ended its bear market of 2022. It ended in October, and then I think it started rallying in November on a CPI report at that time. But the key thing here is that the right now the dollar is really kind of weakening, and that is something that's standing out here. So I think what is interesting about this is to go now to the workspace for sharing, and it has a radar screen and it has this chart. So I'm going to look at the radar screen because what I did was there's I'm going to hide myself now so you can see this. This is really the main thing I wanted to talk about today. Is it basically this has all of the ADRs. These are foreign stocks trading in the United States. Now, if you look at this, you can actually look at the most active ones. Some of them you'll probably recognize, things like NEO, Taiwan Semiconductor, things like, you know what? This should have Alibaba on it. That one trades. These are ones that are on the NYSE, and there's a few on the Nasdaq. But if you look, Citi has a directory of ADRs, and I wanted to kind of point this out because if you actually look here, and what I did was I took these as of yesterday and I averaged them out. And you could basically see that on a 5-day, 21-day, and year-to-date basis, all of those, these ADRs are outperforming. Global stocks are outperforming. We can also see that over here. If we go to MT Main and we go to key ETFs, you can also see that the ETFs, like the Chinese ETF, I don't have many others here, but the Chinese ETF is outperforming by a wide basis this year. And also, gold miners are outperforming this year. And so we're really seeing a weak dollar trade in the context of the weakness in the market. So my perspective here is that one of the things is that for people to be looking for risk and outperformance, to be focusing on the non-U.S. sort of assets and the global equities and things like precious metals is kind of where this sort of relative strength tells us. And the reason is first of all, the U.S. dollar. If we look at, there's a weekly chart of the U.S. dollar index, you can see here this level that we hit in January was the highest level really since November of 2022. And then, so that's an important thing, is that long term, a person could argue that the dollar is in a long term range and it is moving down its range. And you could probably see that there is some more potential kind of space here. The other thing to realize is that the American economic data is now tilting in a more negative direction. When you look at things like the GDP now from the Fed, I mean, that thing flipped negative last week, and it's kind of giving an overall sense of weakening the economy. We get more of that data from payrolls tomorrow, and then we have CPI the week after that, next week, and the week after that, we have the Federal Reserve. So when you look out into the future here, we do have a pretty difficult month. And I think it's a scenario here where, like I said, the data right here is not bad enough. This is the opposite of Goldilocks. The data is not bad enough to justify, you know, aggressive rate cutting, and it's not good enough to justify high multiples. And it's actually kind of, it was good, now it's getting not so good when you look at things like the weakening economic data, and the kind of prospect of tariffs cutting earnings estimates. So all these things together create a very difficult and heavy environment. And I think that's really what we're overall seeing here. So from my perspective, that creates an environment for the United States, for American assets that is not as attractive, and we could see this sort of continued sort of weak dollar behavior, um, for the foreseeable future. Now, I think, the thing is that the overall S&P here has not also gone down to any kind of levels where necessarily there's, any kind of clear support or anything. As we look at the S&P 500 here on the weekly, we had talked about, on state of the market, 5,700 was the level that we had mentioned on our webinar on Monday, and we're not there yet. So from my perspective here, when we look at this overall, there's really nothing yet clearly, giving any kind of sign that, the worst of this, would be over, so to speak. And I think when you look at, other sort of things, um, like we haven't gotten, I'm going to probably on Monday when we do the next webinar, I'm going to look at things like, where is a 10% drop from the all-time high. In fact, we could do that right now with this trading view. Let me just actually, I'm going to take this away. Trading view has these quick little things that allow you to do stuff like the, the price range. If we go from our high and we go down, say 10%, that would basically imply, 10% pullback on the S&P would be to roughly, 55.25 roughly. That would be a 10% pullback, more or less, from the high. And at this point, we're basically at about a 7% pullback. So people looking for something like a nice round number like 10% are not there yet. So, from my perspective at this point, it has pulled back, but for people looking for any kind of clear signal, it's not there on the levels or the pricing. 5,700 was a level, but it doesn't mean that that is necessarily the place where it just kind of stops. When you have this sort of movement underway, the levels themselves are not as important as kind of like, where are we in the overall, process of selling off? Have we actually hit, for example, a 10% pullback, or have we gotten to the point when we think the news is going to change? Or and like I said, with the Fed coming later this month, it's hard to argue now that we've actually gotten to the spot when we have clarity. If anything, the drag is the negative of, like I said, the Fed not wanting to get dovish yet, and the data potentially getting weaker. So those things create just a lack of any kind of positivity. And if anything, people might simply be like, I'm not going to do anything until we get to the Fed meeting. And that could create a lack of bid in the market, an overall lack of any sort of interest. And so volatility like this, like I said on Monday, when ranges start to widen, and when volatility increases, ranges widen, and that is exactly what we're seeing here. And that just creates the potential for like bigger and bigger moves. So at this point, people looking to enter don't have a clear reason yet. Um, so and at this point, I don't even want to talk too much about some of the ADRs and some of these names. I would mention that today it was kind of interesting that Alibaba actually had, some interesting kind of news. They announced they had some kind of AI come out that has actually been, good for the Chinese stocks today. Last week we talked about the Chinese electric vehicle stocks, and you might want to go back and look at that. I mean, they were outperforming Tesla by this huge margin. So overall, I think we are seeing a relative strength right now in, things like China. There was also an interesting sort of article. If you look here, it was on S&P Global, which sometimes has some really interesting insights. They basically, apparently there's something in China that might push the insurance companies to invest a certain percent of premiums into domestic equities. This is something that is potentially very interesting, and it hasn't gotten that much attention. But Xi has gone basically from being, really anti-market to being much more pro-market in the last 12 to 18 months. And the market, at certain investors at a certain point, can take a step back. So when you see the things like the Alibaba news, you see things obviously like DeepSeek, or the outperformance of the Chinese EVs, or the outperformance of the Chinese, phone makers relative to Apple. You put all those things together, and there is, people might see potential for this Chinese outperformance to continue. We've been talking about it, but this is maybe a trend that people may see continue for a while, until at least we get to a spot where the multiples are closer together, maybe where we have a little bit of sense of tariffs being in some ways at a point of stability and predictability. So I want to kind of point that out, that there does seem to be an outperformance in these in the Chinese stocks and in global stocks overall, and this sort of weakness in the dollar. And this is in many ways, I think, what we need to focus on. And it also creates a situation where, what is America? It is Nvidia, it's Meta, it is Microsoft. Those are the American dollar stocks. If people are buying dollar assets, that is the big, there's treasuries, and that's obviously, something. But when we talk about stock investing, that is the meat and potatoes of what it means, for domestic equities. It's the S&P 500, and it's those large cap companies. So it does create an environment where those names maybe don't have the same kind of money flowing into them that they have had before. And if we're in that process of money shifting from domestic to global, from Silicon Valley to China, not to say it's going to last forever, but it could last for a few months or something. That is the trend we're seeing now, and this is market trends, and that's the sort of thing we talk about on market trends. All right, so overall, a few things are interesting here. There are some notes of Bank of America saying, positive things here um, about the German news. It was also kind of interesting to notice that there was Goldman Sachs lowered their earnings growth estimate. Tomorrow we're going to get the FactSet data, which will tell us what earnings estimates for Q1, which comes out next April and May, what those earnings estimates are expected to be. We're going to start to get that. But I think we have to realize is that there was a huge expectation that we were going to have 3 consecutive quarters of double-digit earnings growth, and that scenario is no longer operative. And what's happening is those earnings estimates are getting pushed out to later quarters, but that's what they do. First, like the guy at Goldman, I think it was David Costin, he went from 11% growth to 9% growth. But then the thing is it's really about the pendulum turning, or the kind of battleship turning. Goldman does it, then someone else does it, then someone else does it. It goes from 11% to 9%, then it's 8%. And that's the way this sort of thing happens. And the thing is, when you look at the economic data, when you look at the earnings, we seem to have had a turn that is pretty pervasive. And so I think we just have to realize that, again, with the multiples where they are, it makes it hard to kind of, keep pushing on that. Let me just see if there's anything else here I had to cover. So hopefully you guys are able to check out this. Remember, this is the workspace. It's actually just today's date, 2025-03-06 is how I wrote it. Otherwise, I end up with these really big names. But this is in the zip file. If you actually go here up to the top of this article, I have it in a zip file here. ADR list is available here if you want to see it. Let's see. The last things I wanted to kind of mention, if anything, was that if there are any names that are showing some kind of potential here, for individual opportunities, JD is a Chinese, tech e-commerce company. So JD here is in a spot where, you know, this is one I think we're kind of watching. It's kind of this high basing pattern here, and this might be one where it pulls back maybe a little more down into this range. But this is one where all the moving averages have recently kind of lined up. I want to kind of point out this one. It's interesting if you look at this on a longer term. I mean, it's basically people might see signs of bottoming in a name like JD here. So want to kind of point that out. JD was one, but to the downside, Microsoft, I was actually surprised by how well it is held in here. And, people looking here for some downside. I don't have time to pull up Option Station Pro, but we had talked about, sorry. All right. We had talked about Microsoft going down and testing this level, and it did. And I think now, essentially, it's just rebounding up to the falling 8-day exponential moving average. So at this point, when you look at things that might have that opportunity to kind of probe back to the downside, Microsoft, high multiple, all those sort of things. The one thing about some of these names is the weaker dollar to a certain extent gives them a little bit of grace in terms of their earnings, potentially not getting a little bit of a benefit from a weak dollar. But overall, I wanted to point that out because a large mega cap like this, Microsoft coming back up, you can see here something of a downtrend in it. People might look at this for potential downside. The last thing I'll show you very quickly, go to MA Tools on the the MT main workspace, and you go to data, bring in like the NASDAQ 100 here, we can find stocks that are basically hitting the falling exponential moving average. So that's just a little really quick sort of technique I want to show you guys. I use this when I'm looking for sort of trend following opportunities. If we look here, go to EMA test, okay, and it's going to basically show us here. So they're going to populate in, and it's going to basically show. I mean, we can probably see here. See, there's Microsoft. It pops up on that. So we can kind of look down our list, and these are stocks that are hitting the rising 8-day exponential, and you can just kind of look down the list. I would be looking for you see the average options volume. It's in this. Wait, I'm sorry. Let me hide myself, and I'll be gone in 1 second. Let me just really quickly show you this before it ends. So average options here will show you the names that are most liquid. It lights up because it's over 10,000 contracts a day, and then we can just look down the list, and what do we see? We see Google or Alphabet hitting its falling 8-day exponential moving average. We see Microsoft hitting its falling 8-day exponential moving average. So even Netflix, hitting its 8-day. Now this is one that's kind of wow. Look at this filling this gap now. I was watching this one and kind of wondering about it, and now here I look at it just filling the gap. So there are other names like that. We recently did a trading view idea, by the way, on Royal Caribbean. I would actually just mention the other one that was interesting was CCL. CCL broke a support level and just has been breaking down. These are cyclical names, okay? And the thing is that if we do have an economic weakness, things like cruise ships, might not be in a great place. And the other thing is they've run a lot. So I want to kind of point that out that the cruise ships here are in a spot where people might actually see them for some weakness to the downside. But anyway, those are the main things I want to talk about. Remember, we will be back on Monday with state of the market. We'll be looking at where the S&P is. And we're going to take some longer term looks at the S&P and maybe look at some levels that people might actually be kind of paying attention to on the longer term chart. So I hope everyone has a great day, great weekend. Remember, payrolls in the morning, then Jerome Powell in the afternoon, and I'll see you guys on Monday. Have a good one.